Hey everybody, we will be doing the new format once again today. The topic of the video will be SoundHound. Now they are basically an AI company. I believe they might be specializing in like the automotive side of AI. CRNC, the company I reviewed about 2 weeks ago, is one of their more direct competitors, but SoundHound is kind of like the older brother of Cerence, where they're actually cash flow positive and doing fairly okay in the stock price game. So let's get into it. Make sure to subscribe and SoundHound. All right, so looking at the financials first for SoundHound. So I don't remember if I mentioned it in the intro, but what I'm going to be doing from now on is looking through the financials. Then I'm going to be looking at their chart, which we'll get into later. And then I'll be looking at some highlights from their most recent earnings report showing more company specific metrics, things like that. So it's not just base financial statements. I got a few comments saying I should try to expand it more, and I completely understand it makes sense to do so. But yeah. So let me clear this out and we will get started with the financials. So cost of capital is at 12.1. Now again, with a smaller AI company, I'm going to be honest, the cost of capital rating, unless it's like 20%, I'm never going to not give credit there. Target price is above $8. Long-term growth rate is not stated. However, I'd imagine with it being a AI, artificial intelligence, technology related company, commercialization of voice, sound, and natural language AI. So I'd imagine their growth rate is very, very good. So going to the income statement, let's see how they're holding up. Should be really, really good. Sales are looking fantastic. Let me just make sure these are okay. So these are in thousands. So this is 45 million, 67 million. So still decent amount of sales growth, especially compared to where we used to be with the company. Let me zoom out a little bit. But decent amount of sales growth in the past few years. So I'm liking that. Operating income is not where it should be. One thing to say is that at the very least, it is stable, although it's supposed to be increasingly negative this year, but does not look great. They definitely need to turn around that profitability part of their company. The net is basically the same story. EPS is going to be the same thing. EPS is not terrible. It has actually been improving. However, I'm assuming that's because of increased shares, which it looks like it is. So I will give the point there for improving EPS. But again, you also have to take into consideration that it is most likely because there's just more shares to calculate with. So total shares have been getting diluted. They were at 200, now they're at 369, which is I'm not really crazy about it. But with the sales growth they've seen, hopefully they can turn that into more profitable growth and stop diluting so much. But we'll have to see in the future how that turns out. So cash situation looks okay compared to their short term. They brought short term down a lot in the past few years. And they have been increasing their cash. It looks like they're at an all-time high in cash right now, which is definitely something. Assets have been increasing, at least compared to, they actually took a dip in 22, but let's go into quarters so we can get a better look at what this actually is. So from the quarter screen, you can see their assets have been increasing fairly consistently. A little dip 2 quarters ago, but that's no big deal. I like that. Short-term debt has been fairly minimized. I mean, you could see they've really brought it down. Now it's under 2 million. Should be million. Now it's under 2 million, which is always nice to see. So I'm liking that. Now, in terms of their long term, you can see on the quarters view, their cash is fairly significant compared to their long term debt, which is great. Their long term debt is nowhere near as high as it was about a year ago. It's 70, 80 million. It's at 41 now, which I like. Decent improvement there. And then retained earnings most likely should be negative, which they are. They are fairly consistently negative, though. They've actually been very, very slowly increasing, but that isn't too bad for them, seeing as the sales growth is so significant. But let's get into the cash flows. So for their cash flows, their operating obviously is very, very negative. I mean, you saw how much the SG&A expense was earlier. They are spending a lot of money on developing sales growth, so they're not really looking towards operating profitability at the moment, which is completely fine. For the investing, it is actually negative because I'm seems they're putting money into acquisitions, which is awesome. For financing cash flow, also negative. It looks like they have been reducing a lot of debt recently, which we saw earlier. So that is really, really good. And then free cash flow, I think we all expected this big negative. I mean, obviously they had negatives and everything, but free cash flow is negative. It's increasingly negative over the past quarter, but that's not the end of the world for them. But we'll have to see if they're able to. Later on, we'll look into seeing if there's any projections about them being cash flow positive or neutral in the near future, but we will get into that later. Let's check out their use of cash. So we should see some pretty big debt repayments. You can see that right here. That is fantastic. I am loving it, McDonald's. But stock repurchases, it looks like you could see they have been issuing a lot. Now, one thing with their issuances, while I am going to give the big fat zero there, their issuances have most likely been used to pay off their debt, which is sometimes a better thing. It is most likely better. I would rather them have more shares than have 200 million extra in debt. So that is not a terrible thing. Let's move into the ratios, see how that looks. SG&A to sales was very high, was fairly high. It is lower than what it was, but again, having it being 200% is kind of crazy. They're spending double the amount on expenses than their sales. I am going to give it the 0.5 because it has been improving. We can go into the quarters too, just to really solidify the improvement. So you could see 4 straight quarters of decreasing. They are working it down, getting towards that cost effectiveness, hopefully turning their sales into a more profitable amount of sales. For net margin, it's the same thing for the most part. Very, very negative, but used to be much, much more negative. I'm still going to give the 0 there because net margin is more of a, if it's negative, you are losing money. But so it is improving. You could see they are very steadily and consistently working towards positive cash flows, positive profit. For ROA, ROE, again, it's the same story where it is slowly becoming closer and closer to a net positive situation. And then long-term debt to total equity should actually be really solid, which it is. 14% is nothing. So that is excellent. I know I have here decreasing and below 100%, but again, 100% is more a metric geared towards larger companies like Disney. I forget what Disney was at. What Disney had a fairly high debt to equity ratio, but that's another reason that I am going into the other aspects of the stock, like the chart and some financial things or some earnings report things, because every single company is going to be different just based on this rating scale. So while it does work as like a general indicator of like financial health, there are, of course, many other aspects to that. So that is it for this part of the SoundHound review. Let's get into the chart. So I'm just going to move right into here. So you can see they have only been public for a fairly short time, going public in mid 2022, and saw a very steep drop right off the massive explosion right off earnings, and then dropped lower. So I'm assuming what happened was they got caught up in some AI hype, had a bad earnings report, and dropped. But this is the weekly. Let's zoom out a little bit and just look at recently. So you can see this clear uptrend recently. Now they had what I'm going to assume is a lot of hype around AI that essentially drove massive growth into them. And they went from $1 to $2 to over $10 within just a few, that's just about a month and a half. Now they dropped back down, but kept making higher and higher lows since then. So honestly, the stock looks like it's in a great position to growth with all of their financials increasing fairly steadily and improving their net margin, things like that, their SG&A to sales. I can definitely see further growth in the future with this trend continuing. We could see them consistently getting towards double digits within maybe a year or so. So that is definitely something to pay attention to with their chart as they continue to make these higher lows here, continuing to go up. And especially with their most recent earnings report being fairly good, I'm expecting some further growth there. So now I know this is just a wall of text, but what I'm going to do is just kind of point out some specific things for them. So one thing immediately, increase of 89% year over year for revenue, gross margin 49%, 60% non-GAAP. They did obviously have a net loss, which isn't too bad for them. They do have the cash to cover it. They completed an acquisition, which could lead to a lot of fairly good things. And then they just have some highlights here. Nothing too crazy that I want to look at. But again, if you want to pause and read some of this, this is just some innovative things that they've been doing recently. So basically all good stuff. You kind of see they've got a lot of awards recently, which is awesome. And then this is just financial statement stuff. Now, one thing to note is revenue to be in a range of 82 to 85 million for 2024. And their revenue for 2025 is looking to essentially double, which should be really, really good for them as long as they could hold up to that guidance. And that is about it. This is just some other forward-looking statement stuff. But so that's for them. Again, raises outlook. That is what we're seeing with their stock price moving up so much on these earnings. You could see right here. Raises outlook is always the key word that you want to see for companies' earnings reports. So that's it for SoundHound. I hope you enjoyed. I hope you learned something. Make sure to subscribe, and I will see you in the next one.